Okay, thank you, Shemshare. So I'm going to cover Moody's Global Pharmaceuticals outlook and our recent revision in the outlook. We moved the outlook from positive to stable in June, and these were the drivers of that. Our outlooks tend to be based on our earnings projections over the upcoming 12 to 18 month period. When we look forward today, 12 to 18 months, we believe the sector will grow earnings as measured by EBITDA 2 to 4%. And this is a bit lower than our forecast made back in December when we projected 4 to 6%. So with the passage of time, more products that are going generic come into our view. And I'll cover that in a little more detail. But supporting the 2 to 4% growth are these factors. There are numerous blockbuster drugs, branded drugs, all across the industry that are still growing double digits. There's been a strong wave of innovation. We've had ongoing pipeline launches of high value, untreated medical areas. These are all driving good growth for the sector. And looking ahead 12 to 18 months, the patent cliff is really not very onerous, especially on the more traditional drugs that decline quickly. So not a particularly harsh time period for the industry. But why the growth is slower, now as we look forward 12 to 18 months, we're including more of the products that will face biosimilars or generics. So some of these listed here are Humira, Stelara, Januvia. Another is that something really benefiting growth over the past 12 to 18 months was the easing of restrictions related to COVID. So that had been providing a bit of a lift. As all of that evens out, there's just less growth coming from that. And then there's clearly, ongoing pricing pressure globally, especially in generics, and we'll touch on this a little bit more. But these are the key factors supporting the outlook, as well as the change, again, from positive to stable. One quick note on the particular COVID products. This is really driven in our portfolio by the Pfizer vaccine, as well as Pfizer's antiviral. So these products have generated extremely high revenue and high profits. When we look forward, we do believe this will wane. Very hard to predict, the exact magnitude. If we do include our projections for these drugs declining, then this would actually pull the entire industry EBITDA down about 6 to 8%. So we would see shrinking of industry earnings. But we're not moving the outlook to negative just on that basis. And that's because the underlying fundamentals across all the other thousands of products, as we mentioned, are strong. This impact really is skewed to a few of these particular drugs and these particular companies. But we would expect about a 50% decline in some of these products going forward. There will be an ongoing tail. This will benefit the companies involved. But the factors that make this difficult to estimate are just the impact of new variants, whether people want to keep getting boosters. Just still a lot of uncertainty about the pandemic overall. Here's just a bit to support why the industry is still growing at a pretty healthy rate, the 2 to 4%. Here we highlight a lot of the blockbusters across the industry. We believe the strongest categories remain oncology, immunology, and the metabolic diseases. So this is spread across a lot of products, a lot of different companies, but these are things we're highlighting that should be growing still double digits. The biggest market, remains oncology, with drugs like Keytruda, Opdivo still exhibiting very strong growth. These are also areas of investment, where we expect continuing M&A. We may come back to that. And then here, we're highlighting some drugs that we think could be approved from various companies' pipelines over the next 12 to 18 months. I think that the most attention will certainly be on the Alzheimer's disease area. We did have the approval in the US last year of Aduhelm, but that approval has been controversial and the sales are not very high. But 3 other Alzheimer's drugs are in the very late stage pipeline. There's phase 3 data pending. This is going to be very important to see, what kind of potential these products have. But other companies have good opportunities here, and we're seeing a little more opportunities in vaccines, including for RSV. But again, this supports the stable outlook for the industry based on the opportunities here and the likelihood that many of these are going to be approved and generate rising sales for many years to come. As far as the patent cliff, our view, this has been the case for several years. What's going generic this year and into 2023, it's really not a lot of products. And in particular, it's not a lot of traditional oral solids. The ones we've highlighted that are large are Humira, Stelara, both of which are biotech drugs, and then Merck's Januvia, Janumet, which is a small molecule. But this does not create, many opportunities for generic companies. We see the exposures picking up a bit from 2024 through 2026, but we do believe the steeper cliff is coming around 2027 through 2029. Some of these as well are going to be biotech drugs and opportunities for biosimilars, but this is going to be really a period of challenge for a number of companies. We think it'll drive M&A. So there's sort of this near-term, medium-term, and long-term view of the opportunities for generic companies and for biosimilar companies. And then switching to biosimilars, we're really still trying to track on an ongoing basis how the biosimilars as a whole are doing in terms of uptake. And one way we measure this is starting with the level of sales for the innovator product just before it hit biosimilar competition. And from that, we look at the sales of that drug in the subsequent quarters. And we're tracking this in Europe separately from the US because the fundamentals are a bit different. So this is the European sales erosion of the innovator drugs. And I think the curve is being pretty well established here. We do see that for the drugs launched more recently, like some of these Roche drugs, Rituxan, as well as Avastin and Herceptin, the erosion now is about 60 to 70% after 2 years. So it's steeper than the older drugs that face the biosimilars. A lot of these drugs are the provider administered drugs. And I'm going to switch now to talk about the US market because that distinction is quite important. So in the US, we've just had fewer biosimilars launched, not as long on the market. But what we actually are seeing is that the erosion on the provider administered drugs is pretty similar. So it's these same Roche drugs like Herceptin and Rituxan. And again, after about 2 years on the market, the innovator drug is down to just 30 or 40% of its pre-biosimilar sales. So it is following that pattern. But when you look at the upcoming drugs facing biosimilars, in particular Humira, these are not provider administered. These are self-injected by patients. And in the US, the health system is such that the management of the costs and of these medicines goes through the PBMs, the pharmacy benefit managers. And so we really don't know, exactly how steep the curve will be because we haven't seen large drugs of that type that are managed by the PBMs actually go biosimilar. So there's a pretty big range here on drugs like Humira. But for the provider administered, where patients don't take these drugs as long, these are not for chronic conditions, and the purchasing is made by healthcare providers. So cost is a very big driver of those decisions. And again, we're seeing the erosion that is similar to what has been seen in Europe for several years. And now switching to the generics, this is some of the data that we track. We're looking at the FDA activity on generics. So the blue line is the number of ANDA submissions. Each of these is on a rolling last 12 months basis. The ANDA submissions used to peak at over 1,000 annually back in 2017. It has been steadily declining. And we think that mirrors what's happening as far as branded companies' generic exposures that just are not as high. So you do see that coming down. It has ticked up a bit And that's the same kind of dynamic where maybe next 12 to 18 months, not a lot of generics will be launched, but a time period, after that, the medium term, there should be more. So we're seeing the number of ANDA filings going up. The green bar is just ANDA approvals. The blue bar is to include the tentative approvals as well. And all of this is kind of following that same pattern where the opportunities have been less. These have all trended down, but most recently, it does look like they're ticking up a little bit. And on the generics more broadly, some of the companies we rate out of Moody's include Teva and Viatris. We are definitely still seeing pretty challenging conditions where there's ongoing price erosion. We would estimate in the high single digits. This is being offset to some extent by new launches, but because these new launches have not been very high opportunities, we're still seeing a bit of pressure. And it's greater pressure on the smaller companies that don't have quite the critical mass, or the ones that are more focused on the US market as opposed to being more geographically diverse. The conditions we see is not quite as onerous in Europe. There's less pricing pressure. There's ongoing growth in those markets. The volumes are definitely rising in Europe. And then a note here on opioid liabilities. This has been an ongoing overhang for a number of the companies we rate, both generic and branded. But we are seeing progress. We've seen settlements happening in very recent months. Johnson & Johnson, for instance, the 3 large drug distributors have all settled their opioid litigation. A few others, like Mallinckrodt, is doing this through a bankruptcy proceeding. And then a few other companies, it's not quite as far along. We don't have finalized settlements. And what we're doing analytically is typically adding these settlements to debt. We don't do that with all types of litigation exposures. But in this case, when these opioid settlements are a fixed cash outlay year to year over a very definite time period, we believe it is debt-like, and it makes more sense to adjust our ratios to include that as a form of debt. The fact that the payouts are being spread out over many years is making it a lot easier to absorb for these companies. It is part of their free cash flow, but they do have free cash flow to make these commitments. And then the last topic I wanted to touch on is just one of the social risks related to drug pricing legislation that has been developing in the US. For many years, there has not been enough consensus to reach among the different parties in Congress to pass major drug legislation. But it looks like through a slim majority, something may pass in this coming year. So we've published different reports on this, but the key provisions that are being looked at would be allowing Medicare to negotiate drug prices. That has never been part of the system before. And then curbing the price growth by putting in new rebates back to the federal government if the prices rise higher than inflation. And then redesigning the Part D benefit package, which is for seniors on Medicare, to help with the cost sharing and to lower their costs. So each of these does represent a cost to the industry, but we find that it's not particularly severe when we look at how much the government would save and view that as a cost to the industry and measure that against the industry's EBITDA. It comes to about the single digits in terms of an EBITDA reduction. So that's the US. And then in Europe and Japan, it's a bit of a status quo, and then ongoing, practices related to drug pricing do cause pressure, where we typically see about mid-single-digit price declines. So nothing very brand new there, just that it's an ongoing pressure. And Japan, these are now annual reductions. So I'll be happy to take questions, and for now, though, I'm going to turn it over to Kinjal.
Yeah, thank you, Michael, for giving us a detailed perspective on the global pharma industry, the product pipelines and patent exposures, and an update on the regulatory environment. The focus of our presentation today is on the US generics market, which continues to face a tough business environment with intensifying competition, eroding margins, and a rapidly commoditizing oral solid dosage business. We have split our presentation into 4 broad sections. The first one covers an overview of the US pharmaceutical industry. The second section highlights the performance of Indian pharma companies in the US generics market. In the third section, we shall cover the regulatory environment for the US generics market and the recent developments around the same. And finally, we will talk about the FY23 outlook for the Indian pharma industry. US continues to be the largest pharmaceutical market in the world, accounting for around 45% of the global pharma industry by value and around 20 to 22% of global pharma production. Within the US pharma market, branded drugs account for about 75 to 80% by value, while generics account for the balance 20 to 25%. Well, that is a mix by value, since the US has been advocating the use of low-cost generics to contain the overall spending on healthcare. Generics have become the dominant segment, accounting for more than 90% of the prescriptions or volumes. India remains one of the most important contributors to US generics market, accounting for around 40% of the generic supplies by volumes. The generic drugs market in the US had benefited significantly in the past due to large patent expiries. However, over the past few years, the revenues from the US generics market have grown at a relatively modest pace, reflecting a confluence of challenges being faced by companies in the form of consistent pricing pressure, lack of major blockbuster product launches, and increased regulatory scrutiny. This has been partially offset by rising incidence of chronic diseases, increasing geriatric population, and new Me Too or commoditized product launches. Another development in the US pharma industry has been significant consolidation of distribution side of the supply chain. In addition, the commoditization of generics is also causing price erosion across products. The increased number of generic players, along with increased pace of approvals from the US FDA, has added to competition, especially in oral solids. While incremental A&D approvals will support new product launches going forward, continued pricing pressures are expected to impact realizations and therefore industry growth in the near term. US has always been a key market for most large Indian pharma companies, accounting for a sizable proportion of their revenues. For some big pharma companies, the contribution of US business to total revenues has been as high as 50% in the past. However, owing to subdued growth witnessed in this market over the last few years, Indian pharma companies have increased their focus on other key markets, especially India, Europe, and emerging markets like Latin, so that their growth is fueled. Consequently, the share of revenues from the US market has declined steadily in recent years to around 29% of their aggregate revenues as for our sample set in FY22. Growth in the US generics market for Indian pharma companies was fueled by a large number of products going off patent during FY12 to FY16, leading to a steady launch of generics. However, significant distributor consolidation during FY17 led to a steep decline in revenues for the sample set in FY18. In Q4 FY17, the US witnessed the largest consolidation amongst its pharma distribution system, that is tie-ups between wholesalers, pharmacy benefit managers, and pharmacies. With this, 3 groups, AmerisourceBergen, Cardinal Health, and McKesson, now account for more than 90% of the total US pharma distribution market. This resulted in increased purchasing power for the distributors, thereby resulting in significant price erosion. The yearly price erosion, which stood at approximately 5 to 7% during FY17, gradually increased to low teens in FY18, then reduced to high single digit in FY19. While it was low to mid single digits in FY20 and 21, it has increased to high single digits to low teens in FY22. The Indian pharma companies were able to combat the same through new product launches, some of them being first to file and limited competition products like Androgel AG for Cadila, G-Renexa for Lupin, G-Sensipar for Cipla, and so on. This helped partially cushion the impact of pricing pressure, resulting in modest YY growth in FY19 and FY20 for ICRA sample set. However, growth momentum considerably slowed down in FY21 on account of adverse impact of COVID-19 due to temporary closure of doctor clinics in the US in the first half of the year. Moreover, COVID-19 impacted pace of new ANDA approvals and thus revenue growth for companies in FY21. Increase in pricing pressures due to elevated competitive intensity for some drugs impacted growth in FY22. Overall, the US generics industry has witnessed a cycle of rising and receding pricing pressures, such that the easing of the severe pricing pressures has only been temporary. The revenue growth from the US market for major Indian pharma companies remained suppressed in the last several quarters, owing to continued high single-digit to low teens price erosion in the US generics market. Citing continued pricing pressures and high competitive intensity in the US market, some major Indian pharma companies reported sizable impairment losses in recent quarters and have discontinued some products or segments due to reduced revenue visibility and thus lower earnings potential. While the demand for COVID-19 drugs aided operating profit margins in H1 FY22, margins witnessed sizable contraction of 350 basis points in H2 FY22 due to elevated raw material prices and increased pricing pressure. Interestingly, not all companies were impacted similarly by the ongoing headwinds. While some companies in our sample set witnessed degrowth of 10 to 15% in revenues from the US market in FY22, some companies witnessed growth ranging from 4% to 13%. This was also partly supported by the depreciation of the INR against the USD. So what factors adversely impacted certain companies more than the others? Companies which derive a significant portion of their revenues from a small basket of products or oral solids in the US were severely affected by the pricing pressures. Further, given the slower pace of approvals from the US FDA, lack of new margin accretive product launches, this impacted the margins of generic players adversely. Also, while some companies would have exited certain molecules earlier due to various reasons, lack of new product approvals led to re-entry of these companies in such molecules, leading to elevated competitive intensity for companies in these molecules. We shall now take a few minutes to discuss the various steps being taken by the Indian pharma companies to tackle the pricing pressures in the US generics market. With continued pricing and competitive pressure on oral solids, pharma companies are expanding their basket to first-to-file opportunities and increasing offerings on complex or specialty dosage forms like injectables, inhalation, dermatology, ophthalmics, and biosimilars. Specialty medicines are latest generation products which are targeted at treating chronic, complex, and rare diseases. They accounted for about 35 to 40% of the global pharma spending in CY20, up from around 30% in CY 2015. For the US market, the share of specialty or complex generics is estimated to be about 40 to 60%. However, developing a specialty pipeline entails high upfront investments for long-term benefits and has a long gestation period. Specialty products also entail high risk. Since these are usually blockbuster products, success for a particular product can improve the company's earnings multifold. However, on the flip side, any failure of a product could result in large write-offs or impairments on the investments made towards the product development. Thus, the number of complex generic competitors is likely to be relatively few, as barriers to generic entry for complex products remain sizable. Leading Indian companies also have a biosimilar pipeline or have already launched products in the India and emerging markets. However, only a handful of Indian companies have so far successfully launched in developed markets of US and Europe. With competitive pressures expected to sustain in the medium term, companies are exiting product development of easy-to-manufacture simple generics with multiple players and focusing on specialty products, complex generics, and difficult-to-manufacture products with limited competition. Like several US pharma companies who exited certain me-too generics in the past, Indian pharma companies have also started exiting or phasing out certain products, especially oral solids, which are experiencing severe pricing pressures. The launch of new and innovative products will be a key driver of growth for the Indian pharma companies in the US market. The next initiative by pharma companies is towards cost optimization, which includes improving productivity and efficiency of R&D and manufacturing networks. Companies have started rationalizing their R&D spend. Thus, the R&D spend for ICRA sample set gradually reduced to around 7% of their revenues in FY22 from about 8.3% in FY16. Companies have also started leveraging their portfolio built for US market across markets with similar regulatory regimes so that they can benefit from sales in those markets while not having to bear additional product development costs. Overall, FTFs and exclusivities will remain the key profitability drivers for large generic players. However, this also results in significant volatility in quarterly earnings. All major Indian pharma companies have combated pricing pressures in the US market through regular new product launches in the past. They have a strong pipeline of ANDAs pending for approval. While this may also be partly attributable to delays in approvals by the US FDA due to the pandemic, this also indicates healthy growth prospects going forward. Moving to the regulatory environment and recent developments. The Generic Drug User Fee Act, GDUFA, came into effect in October 2012, resulting in faster turnaround and steady increase in pace of ANDA approvals. The GDUFA laid down goals for approval timelines, gradually improving to approvals within 10 months of submission for 90% of the filings. However, in the recent past, pace of ANDA approvals was impacted by the pandemic due to inability of US FDA to conduct physical inspections. Overall, the US FDA continues to support generic drugs industry by issuing guidance for bringing complex generics to market and also granting incentives such as exclusivity and competitive generic therapy for first generic entrants. The continued pricing pressure on generic drugs has led to lowering of ANDA filings as evident from the exhibit, where annual ANDA filings reduced to 800 to 850 in CY20 and CY21 as against 900 and 1000 in the past. Further, due to the decision of some major players to exit molecules where price erosion has been substantial, the pace of approved ANDA withdrawals increased sizably in CY21. Total ANDA withdrawals in CY21 were 510, almost 11% of the preceding 5 years cumulative ANDA filings. These comprise 402 approved and 108 unapproved ANDA withdrawals. Due to the same, some Indian pharma companies have also taken impairments in the recent past on account of uncertainty in future cash flow generation from some products. The issuance of warning letters and import alerts for India-based manufacturing facilities had increased significantly over CY15 to CY19, following the US FDA's greater focus on compliance of CGMP guidelines. With a slew of warning letters being issued to some of the leading pharma companies, such regulatory actions have emerged as a key risk for the sector, as they result in supply issues, as well as delayed product approvals and launches in the US. Companies have been taking site transfer, especially for major launches, and pursuing filings from dual locations for future ANDAs. Further, warning letters or 483s include recurring issuances for certain large-size formulations manufacturers. Apart from warning letters, several companies have their manufacturing plants being put on official action indicated status or 483s issued and could receive warning letter or import alert if not remediated on time. The pace of ANDA approvals as well as issuance of warning letters to Indian pharma companies has been lower over the past 2 years, given US FDA's inability to conduct physical inspections in light of the pandemic. However, the same is likely to pick up over the medium term as inspections gain traction. The operations of Indian pharma companies remain exposed to such regulatory risks, arising not only out of regular scrutiny by regulatory agencies like the US FDA, but also by the US DOJ and the SEC. More recently, Indian pharma companies have reported sizable provisioning and settlement payouts against some of the ongoing litigation, which have impacted their earnings and balance sheets to an extent. There have also been several one-off incidents, such as product recalls and penalties for failure to supply. Most major companies have various ongoing litigations related to patent claims, antitrust litigations, and remain vulnerable to any further adverse developments on the same. The patent expirations in the US are expected to be nearly $135 to 145 billion from CY 2022 to CY 2026. As mentioned by Michael, these are modest and the major opportunities will arise from CY 27 to CY 27. We now move to the outlook section. ICRA's outlook on the Indian pharma industry is stable. ICRA expects mid to high single-digit price erosion in the US generics market to continue to exert pressure over the near term, resulting in muted revenue growth of 1 to 3% for the Indian pharma companies from the US generics market in FY23. However, the same will be compensated by higher growth in other markets, resulting in an overall revenue growth of 7 to 8% in FY23 for ICRA sample set of Indian pharma companies. Coupled with this, elevated raw material prices and packaging costs, in addition to relatively higher freight rates, is expected to result in moderation in the operating profit margin for our sample set to 19 to 20% in FY23 from 21.4% in FY22. ICRA expects the R&D expenses for the industry to stabilize at 7 to 7.5% of revenues for the sample set as companies continue to focus on complex generics, first to file opportunities and specialty products. Despite ongoing capex estimated at rupees 15,000 crore annually, ICRA expects the sample set's capital structure to remain comfortable with total debt by EBITDA of 0.8 to 0.9 times and maintain strong liquidity profile. Overall, ICRA has rated 42 companies in the pharmaceuticals formulations industry. Driven by growing scale in international markets, expanding product portfolio in both branded generics and pure generics markets, the business profile of some of the key formulations companies continued to strengthen over the last decade, enjoying a positive credit ratio. During FY22, ICRA downgraded 3 entities and upgraded 7 entities in the formulation space. The rating upgrades have happened on the back of healthy revenue growth, supported by uptick in demand due to surge in COVID-19 related drugs in H1 and overall demand with easing of COVID-19 related restrictions in H2, leading to consistent accrual generation and thus improvement in credit profile of these entities. This last slide plots comparison of some of the Indian pharma companies rated by ICRA. While overall scale of operations and margins varies significantly across companies depending on their product portfolio and geographies they are present in, overall most companies have healthy credit profiles. While here we have highlighted gross debt by EBITDA, most companies also have healthy balances of cash and liquid investments. With this, we come to the end of our presentation and would now hand over to Shamsher for starting the Q&A session.
Thank you, Kinjal, for a very detailed presentation, and Michael for sharing the overall global perspective. We'll now request our audience to please share their questions in the Q&A chat box, and we take it forward. Before we have questions from the audience, I have a few questions, Michael, particularly for you. You mentioned in your presentation that the generic opportunities have not been very high in the past few years, and they're likely to be low in the next 12 to 18 months as well. When do you anticipate this changing?
Well, I think the more dramatic change really is not going to be until 2027 through 2029. That patent cliff has both biotech drugs and small molecule drugs. But a lot of what we're seeing in the next few years are going to be some biotech drugs that go generic. There's just not a whole lot of large traditional drugs. But in that patent cliff, 2027 through 2029, we do get a bunch of the Pfizer drugs. For instance, we have highlighted Pfizer's having high exposure. These are products that are small molecule drugs like Ibrance, Eliquis, Xtandi, Xeljanz. So that's going to be, I think, a little more of an inflection point. And up until then, just kind of, more modest opportunities, again, particularly for traditional generic drugs.
Sure. Just a follow-up question here. What are your overall thoughts on how lucrative the biosimilars market will be? Because, when the entire opportunity started panning out, the main expectation from biosimilars were that the price erosion is unlikely to be as significant as we see in the normal generics. What are your thoughts on this?
Sure. I mean, I think a lot of that is intact in that for any given molecule, there will be, a smaller number of biosimilars that launch compared to on a traditional drug where there could be, more than 20. And the price difference will not be as high. And the price erosion year to year also will not be as high. But all that said, these are all still risks of being in biosimilars. There's going to be competition. There's going to be share loss as more biosimilars on a given molecule enter, and there will be pricing pressure. So I think what's interesting is very recently we're seeing a lot of shifts in companies kind of expanding or companies exiting. We're seeing Biogen, which is much more thought of as a branded biotech company, but has had a role in biosimilars, and they are basically exiting their joint venture with Samsung Biologics. They're monetizing that. And then we see Viatris, which is a player in all types of products, traditional generics, branded, off-patent drugs, and biosimilars. They as well are basically, exiting by forming a new joint venture with their partner, Biocon. But it's basically an exit to that market. So these are companies saying it's basically better to monetize now than to stay in it. Meanwhile, there's Amgen, which is a very large branded biotech company that has very clear aspirations to double their own biosimilars business from about 2 billion to 4 billion. So I do think what's clear is that success is probably going to be more on the companies that have the full integration. This was something Viatris cited in exiting, that it doesn't have vertical integration or complete integration, whereas a company like Amgen does. And then the growth for any of these companies, I think like regular generics, the growth is going to come from launches of new drugs. So the Amgen growth, from 2 billion to 4 billion, it's going to be driven by launching Humira in the US, and then launching Stelara, and launching, other drugs. Without those launches, I think like a traditional block of generic products, it would decline. So it's going to be these, subsequent launches of major blockbusters coming up, like Humira and Stelara.
Sure. So according to you, I think vertical integration is going to play a very important role when it comes to having the right set of success factors for the biosimilars opportunity, right?
I believe so. And that's where, you see a company like Amgen staying in, committed to it. And it's really part of the company's growth strategy that, Amgen historically has not been high growth. A lot of their brands are mature. But one way the company will deliver overall growth heading towards 2030 is through their biosimilars business. So for Amgen, it's actually a growth engine, but again, driven by the new launches. And as you said, the vertical integration will certainly help.
Sure. How much share do you think biosimilars are going to get in the US market?
Sure. I mean, it's hard to say where it'll peak, but the erosion curves we showed, they weren't really share. They were just how much of the sales have been retained. But I think they, in some ways, track to the share, because when we look at other sources that report share data, we do see biosimilar share on, say, those Roche drugs like Rituxan and Herceptin. We see that as all over 50%, again, as after 2 years. But it's hard to say where that'll peak out. And then again, the real challenge is on these self-injectable products that go through the formularies, like Humira. That one's difficult. And here, just to give that some context, AbbVie is saying that the decline Humira could see in 2023 in the US is anywhere from 45% to 65%. So pretty big range. And I think as the formulary strategies of the PBMs becomes clearer, then perhaps that range could be pinpointed a little bit more. But definitely hard here to predict the share because the PBMs could incentivize to keep patients on the branded drug through their rebate strategies.
Okay, that's interesting to know. Michael, I'll come back to you with a couple of other points to discuss. Before that, let me toss it over to Kinjal. Kinjal, you talked about the fact that the oral solid segment in the US is becoming rapidly commoditized, right? And we're seeing pricing pressures all across. And with rising raw material costs, it's becoming difficult for manufacturers to maintain their margins, especially in the oral solid segment. So which therapy areas are now Indian pharma companies looking at a more focused way going forward? And how do you see the early signs of success for some of them?
So Shamsher, these oral solid dosages primarily they would be in the tablets and capsules. So they would be across a wide area of therapeutic areas, which pharma companies from India would be catering to. The extent of pricing erosion has been more in therapeutic areas like cephalosporins and anti-infectives. One, which obviously where we see new generation of products continuing to come. And second, where the competitive intensity is very high because of the nature of the product, where the barriers of to entry are low, as in they are very simple to manufacture products. So like I mentioned in my presentation, now companies are exiting these kind of molecules where they are seeing significant price erosions because they do not see earnings potential coming out of it. And they're focusing on more complex, difficult to manufacture molecules in therapy areas of injectables, inhalations, dermatology, oncology, and to some extent even biosimilars. While obviously Indian pharma companies have not been able to make a great foray into the developed markets of US and Europe in terms of biosimilars, but they have tried to put in their foot in the Indian market and have been trying out in the other developed markets as well.
Sure. So just keeping the biosimilars part away, where you said that it's still some time away before Indian companies make their presence felt in the US or the European markets. Within the complex generic space, you talked about injectables, inhalation, and even dermatology, right? So how has been the progress on some of these segments, if you can elaborate maybe?
Definite great progress. So like I said, currently, if you were to see the US generics market, around 40 to 60% of the market is covered by the complex or specialty products. A lot of them obviously are Indian big pharma manufacturers. So several companies, including the likes of Lupin, Sun Pharma, Dr. Reddy's, they have already made large investments in these portfolio of drugs. And they have shown significant growth in this complex or specialty portfolio over the last couple of years. One, by gaining exclusivity, or by being the first to file and gaining the 6-month exclusivity. And second, obviously, by launching a basket of products, which again can be used to be replicated in other markets of, say, Europe or India market, or to that extent, even emerging markets, so that they can reap the value by leveraging the same portfolio of the products.
Sure. Kinjal, one of the challenges which has been, impacting the performance of some of the leading companies in India, especially with focus in the US, has been, spate of, warning letters and other kind of regulatory disruptions. Have you seen any signs of improvement or green shoots on this front? And specifically, over the last couple of years, we've seen that physical inspections by the US FDA were halted. What is the current status on the same?
Right. So to answer your first question, obviously since the US physical inspections were halted over the last 2 years, we were not seeing any major traction there. Neither did we see any significant increase in the warning letters or import alerts being assigned to Indian pharma companies, nor did we see any good resolutions for the ones already existing ones. However, recently, once the restrictions related to the pandemic have been lifted, the US FDA have started physical inspections, and at least 3 to 4 entities we know of who have released that they have gone through the US FDA inspections, and they have successfully cleared those. There could be minor 483s, but at least we are not hearing about any additional warning letters or import alerts at this point in time. But however, since the Indian companies are now lagging behind because of the high number of warning letters and import alerts, which obviously they were not able to resolve during the 2 years of the pandemic, they are trying their best to bring in consultants who could help them resolve the queries of the US FDA so that they can get the EIRs, that is the Establishment Inspection Reports, very soon. Because any major delays in these approvals obviously hampers their product launch plans in the US. And that's one of the reasons that we've seen that some of these big pharma companies have also taken certain impairments in the recent past, where they would have not been able to launch the product at the time they were supposed to, and the earnings potential from those products would have declined significantly.
Mm-hmm. Sure. And I think one of the other things that we've observed, Kinjal, is that companies have been going for dual filings, especially for some of their major molecules because they would not want to afford to have any kind of disruption subsequently. Michael, there are a couple of questions on the biosimilar front. Maybe I'll ask you to take them. So I think the first one you've kind of alluded to in your presentation, which is linked to the kind of price declines that you've seen, and are they still lucrative for pharma companies to really focus upon? And the second one is what kind of monetization value do you anticipate for biosimilar players in the US?
Sure. So, I mean, I think on the first one, what's kind of underlying, one underlying trend in the entire industry is that drugs on the market and pipeline drugs are all kind of steadily shifting, more towards biotech drugs from traditional drugs. So the opportunities down the road for any company investing in biosimilars are going to be very, very large. And some of these products, they're just so sizable. Stelara, a $9 billion drug. Humira was pretty much 20 billion at the peak. Keytruda growing, to over 20 billion. So the opportunities are just so large. And, the barriers to entry are high. So there just are not going to be as many players in the market. So I think that's the thing. I don't think we're going to see new entrants jump in, but for a company that has the capabilities, and once the infrastructure is there, especially on the manufacturing, that can all be leveraged. It doesn't mean it's easy, of course. There's product development risk as well in the clinical trials. But I think that's just the rationale. And again, some players are kind of moving to the side. So it's not going to be the right thing for every player. And then on the monetization value, I just want to make sure I understand it. If I think you're referring to like an EBITDA multiple or an earnings multiple, I don't think we have a specific number. It would be kind of, this is the thing, the multiple would kind of reflect a pipeline as well. It wouldn't just be, what are today's earnings and what's the right multiple. It would be somewhere in between a generic multiple and a branded multiple, because presumably the valuation of any of these players would include pipeline launches to come.
Sure. Kinjal, while we've talked about the upside potential from the expected generic launches in the future, and also about the biosimilar opportunity as well as the complex generics, right? What we've also observed is that unlike in the past, pharma companies, especially the ones which are focusing on the US, right, they're spending far more on their R&D than they were doing earlier, and their R&D bets are now much more concentrated on particular molecules. Whether they're looking at complex generics or they're looking at in-licensing, some of the specialty molecules in the US, right? How do we build this in from a credit point of view? Because now the investments are not fairly well spread out across the portfolio. They're far more concentrated.
Right, Shamshir. So like you rightly said, the concentration of investments is on a small base of portfolio, as against earlier where we would see while the R&D percentage to the revenues would have been lower, it would have been spread over a large base of portfolio. Now with this strategy, obviously there is a huge risk and reward strategy here. So since some of these are very high blockbuster products, if you do succeed in those products, your earnings would jump multifold. And this we've seen in the past also for some of the companies where they have got the first to file and 6-month exclusivity, and they've been able to have a huge quarterly earnings from those products. But that said, obviously, since these products have a long gestation period, the investment requirement is also much higher compared to the simple molecules. In case the company were to fail in the development of the product and were not able to take it forward, the risk of impairment of write-off of investments is going to be significant. And that would definitely hit the balance sheets of these entities. But like I mentioned in my presentation, the balance sheets of these leading pharma companies is quite strong. And to some extent, we've seen these impairments and write-offs which have happened in the past has not really materially impacted the credit profile of these entities. So these risks will continue for the entities, and we will be monitoring those on a regular basis. And any significant high value impairment or write-off could have a material impact, but in the short term, at least, we do not perceive any significant such risk.
Sure. And that said, I think the overall quantum of investments, as you have projected, will remain within the 7 to 7.5% R&D as a percentage of the overall revenues for the sample. Right. Michael, I had one question from your presentation. Early on you mentioned one of the reasons for the change in outlook to stable by Moody's also, kind of factored in, the tailwinds that we had from the COVID portfolio, and especially the vaccine portfolio. Now in India too, we have multiple companies which have been manufacturing vaccines for COVID, while the initial focus for most of them were to take care of the requirements in India, but gradually they're focusing on selling these vaccines across the globe. Right? Do you see a sustainable opportunity for vaccine manufacturers going forward, having most of the population being covered across the globe?
Well, we do think there's a tail, but it's very, very difficult to predict the magnitude of that, because it's going to depend mostly on just the evolution of the virus and the variants, which I can't really predict that. But there's clearly an argument that ongoing boosters, for some number of years, is a reasonable thing to assume. But the willingness of patients to get vaccinated, could decline if the pandemic doesn't seem very severe. If hospitalizations are down, deaths are down, people may just be, a little bit less eager to get another vaccine. So a lot of different variables. But one opportunity is definitely tailoring the vaccine to match whatever the variant is. And this is underway by companies like Pfizer. But those have yet to be approved, but that could certainly drive incremental sales if the vaccine is shown to be effective to what's hitting the population right now. But it may always be a game of catch up where the virus continues to evolve. So there is a tail. When we kind of look at consensus, and this is both on the vaccines and the actual antiviral drugs, consensus kind of shows these opportunities going down by 50% per year for the next few years. And I think that's a reasonable way to think about it, but with a lot of uncertainty either way.
Sure. A 50% drop, while it sounds very sharp, but that's coming on a very high base. So I think the overall opportunity will still remain pretty significant in that sense.
Absolutely. And when you think of it, I mean, this wasn't even an opportunity that was identified, call it 2.5 years ago. So all of it's kind of incremental to where, the industry was 2.5, 3 years ago.
Sure. Just coming back to, the entire generic space, during your presentation, you also talked about potential M&A opportunities coming in, right? Going forward with multiple generic launches expected. Could you elaborate on that? Do you see companies looking for M&A purely from a scale perspective, or is it going to be more focused on acquiring certain technologies or areas where they don't have presence today?
Sure. And I'll touch on generic M&A activity, but mostly we are predicting branded M&A activity. And that's because it's the branded companies, and we have cited Pfizer, Merck, Bristol Myers Squibb as having such high exposures to the cliff. It's not imminent. It's 2027 and 2029, but it's coming, and it's obvious that it's coming, and it'll drive the M&A strategies today, not to wait until 2027 to 2029. So a lot of our view around M&A is focused on what the branded companies will do to weather that cliff, and it'll obviously be to supplement the internal R&D with external, collaborations. That's not to say generic companies themselves wouldn't do M&A, but when you look at the Moody's rated universe now of generic companies, it's a little bit small and it's very low rated. We have companies in the CAA range just due to various pressures they faced, operating challenges, legal exposures. There's not a lot of capacity for M&A among the rated Moody's generic companies. Teva still, the largest globally in our universe, but Teva has been in turnaround for several years and has really committed to deleveraging and to not basically to refrain from M&A until the deleveraging goals are met. So that's one where, not a lot of M&A we expect. Viatris may be a little bit more potential for M&A. They as well still have deleveraging to meet their commitments. So likely not anything major very near term, but once the deleveraging is met, using free cash flow and where, what those opportunities are, it probably isn't just scale. Again, in US generics, it's looking at technologies and pipelines and complex generics, or it's things that aren't even generics specifically, because some of the companies like Viatris, they have a pretty diversified model. They're not playing just in generics. And they're such a global company, so there may be geographic opportunities. But the last thing I should say, at the same time, Viatris is actually looking at divesting some assets. So it could be divestitures followed by M&A. But I think broadly, we don't expect a lot of M&A within generics, in the near term.
Sure, that makes sense. Kinjal, we have a question for you, which is about the overall expectations that ICRA has on, the profitability metrics for pharma companies, and especially, focused on the formulation side. Like what we've seen in the past 12 to 18 months, there has been significant pricing pressure on the top line. And at the same time, the raw material costs have been going up because of the entire supply chain disruption, lockdowns in China, the availability of APIs, etc., have been, under question. What is our sense on, how the supply chain situation is panning out now? And how do you see that influencing the EBITDA margins for pharma companies in the near term, let's say FY 2023?
Okay. So Shamsher, firstly, for the Indian pharma companies, a lot of dependence for the raw materials, that is APIs and key starting materials, is on China. So overall, roughly the Indian pharma industry would be importing around 60 to 70% of its raw material requirement, and of which 60 to 70% would be coming from China. Initially, when the pandemic started and China was the worst hit, that time there were a lot of lockdowns and a closure of manufacturing facilities in China, which really did impact a lot of supplies to the Indian pharma industry in February and March 2020. However, in the current scenario, despite China seeing a recur of the virus and we hearing about lockdowns, etc., as of now, what we understand from the Indian pharma companies is that they've not really been impacted so much, because certain ports are still operational at China, and they've been able to get the raw materials from China. Also, learning from the past where they faced certain issues in supplies because of the lockdowns in China, many of these companies have diversified their vendor base to the likes of countries in Europe. So while obviously those supplies would be much expensive than what they would get from China, at least they have supply security there. So even if they were to face some supply constraints from China, they have developed an alternate vendor base for whatever molecules is possible. Not all molecules would have an alternate vendor base. That said, as you rightly mentioned, we do see a lot of headwinds in terms of, one, increase in raw material prices, increase in freight costs, and the continued pricing pressure in business, in the generics business in the US. That's why we feel, at least as per our estimates, that the operating profit margins of ICRA sample set is likely to moderate to around 19 to 20% from the likes of 21 to 22% that we've seen in the past 2-3 years. That's for FY23. Obviously, going forward for FY24 and 25, it would largely depend on the ability of these companies to timely launch their FTF products. Because like I mentioned earlier, any such blockbuster molecule will definitely boost up the earnings in that particular quarter for that pharma company.
Sure.
But definitely there is likely moderation in the margins going forward.
Understood. Michael, we've exhausted the questions that we had from the audience, but before we close, I would still like to ask you, have you seen any impact of the ongoing geopolitical developments or headwinds as such on the global pharma space?
So the ongoing impact of what?
The geopolitical developments in Europe?
Right. It's, I think, among the rated universe, where we see any sort of potential disruption is in clinical trials. Okay. And this would be the branded universe, where companies have here and there disclosed, X% of clinical trials actually are taking place in Russia. It's not high. It's been, maybe 8%, 10%. So these trials are, not enrolling new patients. Companies will have to, look for ways to get sufficient enrollment in other sites globally. So the disruption, I don't think it's going to be very big. But the sales impact of, winding down or, no longer being in the market is pretty minimal. It's not a large market for the rated universe. I think the only company we've even kind of cited that is Stada, the German company, has a little more presence there than others.
Sure. Great. With this, we would like to end our webinar today. Thanks a lot, Michael, for taking out time and sharing your perspective on the global pharmaceutical industry. I think very interesting times ahead for not just innovator companies, but generics as well over the medium term. So thanks a lot. And if the audience have any further questions, please feel free to write to us and we'll be happy to address the same. Thank you, everyone.
Thank you. Thanks, Michael.